All right, if you're a parent in the US, listen up. A huge tax benefit. I'm talking about one that millions of families count on. Well, it just got a major shakeup. So let's get right into it. So here's the brand new number you need to burn into your memory. For the 2025 tax year, that's the one you'll file in early 2026, it's this, $2,200. Yeah, that's a nice little $200 bump per kid compared to what it was. But, a bigger number on the screen is one thing. What we really need to figure out is, what does this actually mean for your wallet, for your family's finances?
Let's start with that headline change, a new, higher number. And that's really the main story here, right? For the taxes you're going to file in 2026, the child tax credit has officially gone up.
All right, so just a super quick refresher for everyone. The child tax credit, or the CTC as you'll hear it called, is a really powerful tool. And it's important to remember, this isn't a deduction, the kind that just shaves a little off your taxable income. No, this is a credit. That means it knocks down your actual tax bill, dollar for dollar. The whole point is to put some money back in parents' pockets to help with, the crazy costs of raising kids.
So where did this all come from? Well, it was part of this huge bill that passed back in July of 2025. They called it the One Big Beautiful Bill Act. And it did two really, really big things. First, it made that new $2,200 maximum permanent. And second, and this is super important, it tied the credit to inflation. That's a game changer, because it means the value of this credit isn't just going to get whittled away by rising prices year after year.
So, a bigger credit sounds fantastic, right? But the million-dollar question is always, who actually qualifies to get it? And that's where things get interesting, because the eligibility rules got some crucial updates that you're going to want to know about.
Okay, so at its core, your child still has to jump through the same 7 hoops for the IRS. The basic stuff, the age test, they've got to be under 17, the relationship test, the residency test, they had to live with you for over half the year, that kind of thing. We're not going to go through all 7 right now, but just know those basic requirements are all still there. But there are some big changes layered on top.
All right, now this right here, this is the biggest change hands down. It all comes down to identification. See, under the old rules, your kid needed a social security number, sure, but the parent could use an SSN or what's called an ITIN, an individual taxpayer ID number. Not anymore. The new rule says the child needs a valid SSN and this is the key part, at least one parent claiming the credit has to have a valid SSN too. This is a massive shift, especially for mixed status and immigrant families.
And this number, wow, this really puts that rule change into perspective. The Tax Policy Center did the math, and they estimate that because of this new requirement for parents to have an SSN, about 500,000 kids could lose access to this credit. And get this, that includes kids who are U.S. citizens with their own social security numbers. It's a huge deal.
Okay, so let's say your child qualifies. That's just step one. The final amount of money you actually get, well, that's all tied up in how much you earn. So let's get into the nitty-gritty of how they calculate your credit.
So first off, there's actually an income floor. You have to have at least $2,500 in earned income for the year to even start qualifying for this thing. If you're below that line, you're not eligible for the credit at all.
Now this table is really revealing. It shows how much you need to earn to get the full $2,200 credit. So take a look. If you're a single filer with one kid, you need to be making at least $28,700. A married couple with 2 kids, you need to bring in $41,500. What this really tells us is that a lot of the lowest income families, even if they're above that $2,500 floor we just talked about, still won't get the full benefit.
So, just like there's a floor, there's also a ceiling. The credit starts to shrink for higher income families. Think of it like a sliding scale. For married couples filing together, that slide starts downwards once your income hits $400,000. For everybody else, single folks, heads of household, it starts phasing out at $200,000.
But here's a really common question. What happens if you earn enough to qualify, but you make so little that you don't actually owe any federal income tax? This is where a key word comes into play, refundability. It means that a chunk of this credit can come back to you as a refund, actual cash, even if your tax bill is already zero. For this tax year, you can get up to $1,700 per child back as a refund.
All right, so we've waded through the numbers, the rules, the nitty-gritty. Now let's zoom in on the most important part. What does this all mean for real families and their day-to-day finances?
This chart does a great job of showing who really wins with these changes. So look at the first 2 bars. For a single parent with 1 kid making $15,000, there's no difference. The new law gives them the same credit as the old one. But now look at that 3rd bar. For a family making a little more, say $30,000, they get the full $200 boost. It's a perfect illustration of how those phase-in rules mean the lowest earners don't actually see the benefit of that higher maximum credit.
So when families get this refund check, where does the money go? Is it for fun stuff? Well, not really. A poll from the Bipartisan Policy Center laid it all out, and it's pretty clear. The money goes to the essentials. Look at the biggest chunks of this chart: paying bills, buying food, keeping a roof over their heads, and paying down debt. For most people, this isn't extra money, it's a lifeline.
And this quote, this one really hits hard. It's from the Center on Poverty and Social Policy, and it really puts a fine point on the impact of those income rules. They estimate that 19 million children are now blocked from getting the full credit. What's crazy is that's actually more than the 17 million under the old law. So even though the total credit went up, the structure of it means more kids in low-income families are being left out of the full benefit.
Okay, we've covered a lot of ground, so let's zoom out and hit the big takeaways. What are the key things you absolutely need to remember from all this?
All right, here's your quick summary. 4 key points. Number 1, the max credit is now $2,200 per kid. Number 2, the Social Security number rules for parents are much stricter now. Number 3, remember that $2,500 income floor you need to hit to even start claiming it. And number 4, and this is a big one for the future, the credit is now tied to inflation, so its value is protected over time.
And all of this brings us to the big final question, the one at the heart of the whole debate. On one hand, the new child tax credit offers more money, but on the other, it tightens who can get it and keeps income rules that block many of the poorest families from the full amount. So the real question is, does this new setup strike the right balance? Is this the best way to support American families? That's really the core issue that lawmakers and everyone else will be debating for a long time to come.